This meeting is being recorded.
Well, good morning, everybody, or good afternoon, I should say. Thank you for joining us on this critical topic webinar to discuss the economic future of America and drill down a little bit locally here as well. So my name is Dan Cunningham. Thank you all for joining us today. I'm the Vice President of Government Relations and Education for Forward Janesville, and pleased to be the MC of this year webinar. So wanted to do a couple housekeeping items before we get into it. Today's call is presented by BMO Harris Bank. BMO Harris Bank has dedicated bankers in the local market who understand your business, industry, and market and offer solutions tailored to your unique needs. BMO has deep roots in the community with a long history of supporting Forward Janesville and other nonprofit organizations locally. Thanks to BMO Harris for what they do, their support of this organization and the community. This partnership has gone on for a few years now, and it's been wonderful. And part of what's been so good about it is it gives us access to experts like Mr. Gregory and others on the call here. So we're very pleased with that partnership. So thanks to BMO Harris for all their support. So another housekeeping item, I want to remind you that you can submit a question for our participants, our panelists, by private messaging it to me in the chat function. So please go ahead and do that as you have questions throughout the webinar. We'll have presentations from both panelists, and then we'll get into questions there at the end. Finally, don't feel bad. I'm going to play whack-a-mole and go around and mute everybody. We want to make sure that we give the presenters the full attention and no background noises. So go ahead and mute yourself if you're not already. Otherwise, I'm going to come and mute you. So don't feel bad. So again, it's been wonderful to have these experts on these calls, and Michael Gregory is no exception to that. He's our first panelist today. He is the Deputy Chief Economist and Head of U.S. Economics for BMO Capital Markets. He manages the team responsible for forecasting and analyzing the North American economy and financial markets. I've been on BMO Harris's email list for some time, and I do enjoy getting Michael's updates along with the rest of the BMO team. So terrific to have him on board here today. So with that, Michael, I will turn it over to you, and hopefully you'll be able to share your screen and all that good stuff. So the floor is yours.
Yeah, sure thing. Thanks, Dan, and good afternoon, everyone. So I'm going to share my screen now. Hopefully this works, and we'll see what happens. Yeah, thank you. All right. Where is my presentation? Give me a second here, folks.
That's always the hard part.
Yeah, there it goes. Are you seeing that up now?
Not quite yet.
Okay, sorry about that. Excuse me.
That's all right.
Yep. Bear with me a second.
Sure.
Window. Where is the window? I can't seem to find my window. Oh, here it is. Oh, there we go. Got it. Okay.
Perfect.
Do you see that? All right, and we're gonna make that a little bit bigger. Okay, sorry about that, guys. All right, it's kind of funny. We were so used to doing this on a regular basis. Now that we're doing more live stuff, you go back to doing virtual and you kind of flub it up a little bit. But anyway, okay, so I'm gonna talk for about 15 minutes and then hand it over to my colleague to talk more about the local economy. The title of my chat here, I'll talk about 15 minutes, is from here to price stability. Obviously, the big three questions I get from clients from all across the country are, number one, what's going to happen to inflation? Number two, what's going to happen to interest rates? Number three, are we going to have a recession? And all of those three things are, of course, we know are all interrelated. What the outlook and the prospects for what happens to inflation will likely inform the Fed, what they should be doing about interest rates, how high to push them up, how high to keep them, how long to keep them at those levels. And then finally, that then translates into the risks of recession. So from here to price stability, we know what price stability is. It's something around 2%. We don't worry about inflation. Where are we now? Well, we're not quite there yet, but the good news is that it does seem that inflation has at least peaked. We got new inflation numbers out this morning, and headline inflation for the CPI, it fell to 7.1% from 7.7 as recently as June. this thing was above 9%. So inflation is coming down on the core inflation side. We fell from 6.3 down to 6%, the figure. And that was as high as recently in September at 6.6%. So inflation has turned around, has come down. We understand the sort of the genesis of our bit of an inflation problem here. We ended up with a combination of constrained supply and strong demand. You don't have to be an economist to understand when demand outstrips supply, it puts upward pressure on prices. On the supply side, first it was the pandemic, and then more since the beginning of this year, the aftermath of Russia's invasion of Ukraine. But of course, on the demand side, we first had that surge of pent-up demand as we reopened the economy. But on top of that, we stimulated demand above and beyond that. In fact, you could make the case that we probably have overstimulated the economy, hence leading to the kind of inflation pressures we're seeing now. So the question is, are we going to get back to 2% anytime soon? How fast we get to 2% will kind of inform the Fed how high and how high they have to push rates up and how long they have to keep them at those levels. When you dig a little bit deeper into the CPI, you see there's like different things pulling in different directions. It's interesting that it's noteworthy that gasoline prices have come down from the highs we had this summer. Recall, we were paying more than $5 a gallon. Now we are definitely under $3.50 a gallon. And so that's helping to contribute to lower inflation through the energy price cycle, although we're heading into wintertime, and that's always a big uncertainty with respect to natural gas prices. Food prices, continue to be quite stubborn. They're rising still at double-digit rates. And if anything, that's leading to keeping those inflation expectations higher than they otherwise would be. But when you focus just on core inflation and you split that up between the goods side of the economy and the services side of the economy, what you find is that core goods prices that peaked last year have just turned around and have been falling like a stone as we've been dealing with some of the pressures on core prices. Firstly, demand is starting to slow in the face of higher interest rates. Plus, we're dealing with all of those constraints on the supply side, surely, as time goes on. But that downward pressure we're seeing on goods price inflation is being offset by upward pressure on the services side. And there's really two big drivers there. The first of those is what's happening on the rent side. And I'm going to come back to that in a second, because that is kind of a material in terms of the argument. But the other part of the pressure on the services side is coming through the ripple effect of very strong wage growth. And of course, for the services side of the economy, that's a major input to costs. Well, the good news on the good side of the economy is that a lot of the constrained supply, the supply bottlenecks and the disruptions in global supply chains that we had in the wake of the pandemic and subsequent to that, in the wake of Russia's invasion of Ukraine, they've slowly ebbed. And this is a series put together by the Federal Reserve Bank of New York, and it kind of measures, transportation costs globally. It measures the various PMIs in countries around the world, and they all do show that these pressures that we had on the supply chains have slowly began to recede. They've ticked up a little bit recently, but they're far below the peaks we had towards the end of last year, where we had the combination of sort of the greatest amount of imbalance in the economy between demand and supply. Plus, if you recall, this time last year, we were living with a surge in the Omicron virus, which we're not quite sure exactly how that was going to pan out. Turns out it wasn't as devastating for the economy, but nevertheless, that's when we had sort of the peak kind of disruptions in supply chains. And now, of course, we're in much better shape. When you look at sort of America's contribution to that index, and you look at the various PMIs on the goods side and also on the services side, you look at things that were measuring those bottlenecks in terms of supplier delivery delays or the backlog of orders. All of those have come down. And of course, the key thing here at this stage of our inflation cycle, we would very much like to see a lot of these metrics all below 50, which means that companies are seeing their backlogs fall. Companies are seeing their supply deliveries improve, not getting worse. And companies are paying less increasingly for a lot of the inputs they have into their production process, which is happening on the good side of the economy. Prices paid, the latest metric was only 43. In fact, at the peak and that we had, these things were topping 95. Excuse me. Been excuse me, nursing a cold, so I apologize for that. Excuse me. So they've been cut in half. But on the services side, yes, we've seen these bottlenecks begin to fall. However, they still remain above 50, and more significantly on the prices paid side, it's down from the 85 peaks we had, but still remains quite elevated. Most companies are, and on the services side of the economy, as someone can attest to watching this broadcast, know that in fact their costs are continuing to escalate. And that puts upward pressure, or at least puts pressure for them to want to raise their prices, which is adding to the inflation process. So it's really on the services side of the economy where we're really beginning to see a lot of that inflation pressure. And not surprisingly, that is very much coming from labor markets. We know labor markets are exceptionally tight. Yes, they've slackened up just a little bit, but when you look at job openings, currently there's still well over 10 million job vacancies across the country, considering that we still only have about 6 million people officially unemployed, officially looking for work. That does tell you that there's some like 1 in 3/4 jobs for everyone looking for work. The other aspect of that is on the quits rate. Sorry. Oh, my assistant just brought in some water for me. That was very nice of her. You look at the quits rate, you get a sense that labor markets are quite strong when workers feel emboldened. They feel they can quit their jobs and search for other jobs, bid up the wages, and that's exactly what we've been seeing. When you take a look what's been happening on the wage front, all of the major wage metrics kind of soared. And yeah, true, over the last couple of months, they've kind of turned around a little bit. But even then, when you look at where they've been averaging, we haven't seen that kind of wage pressure since the 1980s. So this is literally where the major source of inflation pressure is right now in the economy. And it does beg the question is, like, how much slack do we actually have to see in the labor market to cool wages and therefore to bring inflation on down inflation on a permanent basis? Well, the good news here is we're doing a major experiment. Never before have we had so much of labor demand be reflected in unfilled jobs. And the Fed is hoping that if all these businesses simply just stop hiring, don't start laying off a lot of people, but just stop hiring, that would erase a lot of the wage pressures in the economy and help the inflation process along. We'll see. There's another silver lining in the economy right now, and it has to do with the role of savings. We all know that during the pandemic, because most of us, were able to, still work. A lot, some of us couldn't, but most of us continue working. Our costs fell sharply. We didn't have to buy lunches. We were working from home, and it didn't have to dry clean our suits and things like that. So, and plus we had a lot of support from the government. And we end up building up a huge cache of savings over the through 2020 and through most of 2021. And in fact, when you look at the total amount of savings that we accumulated above and beyond the normal savings we would have done, it ran to the tune of around $2.4 trillion. Now, since the beginning of this year, the savings rate actually has fallen below where it was before the pandemic. And as a result, households and consumers are beginning to tap all of that liquidity, all of that savings to keep spending, which is, it's helping the economy. And they've drawn that down to the tune of around $0.7 trillion. So there still is, $1.7 trillion of savings still at hand to help fund spending going forward. Now, of course, some of that is likely become permanent savings. And therefore it's gone into housing, it's gone into the stock market, and therefore it's not readily available to be spent. And unfortunately, a lot of these savings are not broadly distributed through the economy. They tend to be skewed towards the higher income households. So, the lower income households are the ones that are really feeling the brunt of high inflation these days. And in fact, this is what I would call really a mixed blessing for the economy. While it does help cushion the downturn, knowing that there's liquidity out there to help support spending, it does fly in the face of what the Fed's trying to do here. There's an old adage about the cure for higher prices is higher prices. And if consumers and businesses have the ability to keep paying higher prices longer than they otherwise would, because they've got all this liquidity, all this savings sitting on the sidelines to help pay for higher priced goods and services, well, that keeps the inflation process percolating a lot longer than otherwise would be, which probably explains why inflation, in some respects, has been more stubborn than the Fed's expected. So what's the Fed expected to do tomorrow? We'll hear from them. We look for them to raise policy rates by 50 basis points. That follows 4 consecutive 75 basis point moves. That will lift the policy rate to 4.25 to 4.5. We look for a couple more moves the early part of next year, just to get us just tucked under the 5% range. So a 4.75 to 5% range for the policy rate. And we believe at that point, there'll be enough improvement on the inflation side that the Fed will feel very comfortable about not having to raise rates anymore. However, we think that inflation as it falls will still be a bit on the stubborn fashion, and therefore we are unlikely to see any rate cuts until into 2024, where we do expect those rate cuts to begin. Helping the Fed slow the economy, number one, they're engaging in quantitative tightening, allowing all the assets, all the bonds, and both treasury bonds and mortgage-backed securities they bought all through the pandemic and subsequent, that to allow those to mature and not replace them. That is removing some of that liquidity from the market. Of course, for some of you that do follow markets closely, you know that the yield curve has become inverted, where both 3 months and 2-year bonds, but importantly, those 3-month rates are now well above the level of 10-year treasuries, which historically has been a pretty reliable indicator of future recession. And finally, all of this purposes here are moving all that liquidity and raising rates is to try to ensure that overall spending in the economy slows. And one way to do that is to engineer weaker financial conditions, weaker stock markets, wider credit spreads, higher mortgage rates, and that all combines together to slow the economy down. And we do think it will work. We happen to think that we're heading towards a shallow downturn in the economy. We think we'll probably see potentially a couple quarters here of modest negative growth. And in fact, I think, given that this will be a little bit different than the couple of quarters we had at the beginning of this year, which really wasn't called a recession, because while spending contracted, income continued to grow. We happen to think through the first part of next year, both spending and income will slip a little bit. The unemployment rate will rise a little bit because not all of the slack in the labor market will be generated just solely by people not hiring trying to fill their unfilled positions. But we do expect that we'll see a little bit of layoffs, and you actually see a little bit of hint of that, quite frankly, with some of the marquee companies recently that have announced some paring of their complements. So bottom line is we do expect a little bit of slack here, a short, shallow, modest, mild, however you want to define it, sort of downturn in the economy, a sort of a mild recession, and therefore, but not lasting very long, and sort of bouncing back, and not lasting very long because we have a little bit of offsets in there. Offsets in terms of all that excess savings I talked about. We still have a lot of pent-up demand in the economy, more or less on the services side, but there's an awful lot of demand for goods that didn't get satisfied because there were shortages. And as those goods get delivered, as new cars begin to get delivered, I think that will help spending from that perspective. And another good news is that we're heading into this downturn, unlike a lot of other downturns, with exceptionally strong labor market conditions. And so, yes, we're going to get some slackening, but from a position of strength. So labor markets will still be historically on the tighter side, and I don't think we'll get a lot of mass layoffs and things like that, for the simple reason it was very difficult to hire workers over the last little while. And we all know before the pandemic recession, the number one issue that we all had as businesses was we couldn't hire enough workers, where there were labor shortages in 2018 and 2019. Well, guess what? As the economy begins to grow again, we're going to be facing those same problems again. So I do think, businesses would rather not sort of go whole hog and reduce all of their labor, only to have a difficult time hiring it back when the economy grows again. Finally, for my last chart, what does this all mean for inflation? I think it means that inflation is going to continue to fall. I do think that it will still be running above 3%, 3.5% by the end of next year, but on the road to 2%. And that's the important thing to keep in mind. That's the goal the Fed has. And as long as, by the end of next year, we're on a clear path, if not already there for 2%, the Fed will feel very comfortable beginning to cut interest rates, which is what our forecast is. Now, a couple of things to keep in mind. While the cyclical dynamics here are going to be overpowering in terms of weakness in the economy, pulling down inflation, we do think once that all dust settles on that cycle, that the run rate for inflation may be a little bit higher than it was in the past, simply because the benefits of globalization won't be to dampening prices to the same degree they were before. Yes, we still have globalization, but not as widespread as it was. Let's just face it. America and China are still in the midst of a trade war. And I do think we get new secular forces of inflation are coming back, particularly through climate change, and that does suggest some upward pressure on carbon-based products, and of course agricultural products, which are highly susceptible to changing climates. And again, getting back to the thing I mentioned before, these chronic labor shortages, they're not going away anytime soon, and that suggests some upward pressure on the wage side. Now, I will leave it at that for now. I will stop sharing and turn things over to my colleague, who will now get into the implications for the local economy.
Well, thank you so much, Mr. Gregory. That was an excellent overview, and I would encourage you to hang out and answer any questions that do come up. And for those on the call, please do, if you have a question for either of our panelists, please do private message it to me in the chat function on your bottom screen there, and we'll be glad to get to those questions there towards the end. So our second panelist today is Rock County Economic Development Manager James Otterstein. He's a seasoned economic development practitioner with experience at both the rural and urban level, and he's well versed in working with various public and private sector interests. I've had the privilege of working with James for about the last 15 years, and it's just been a pleasure to be with him and to share his expertise today. So, James, with that, I will turn it over to you.
Thank you, Dan. I appreciate everybody's time today. For those of you that know me, I tend to talk very rapidly, so I'll try to keep that pace so we don't hold you up with the rest of your afternoon. But we're going to roll through a variety of trends and observations. Some of these obviously are going to echo a number of remarks that were made by Michael, as well as we're going to add some local context to what it means here locally. And then at the end of the day, I'm going to offer some projections for the 23 forecast. Okay. Well, you can't have a conversation about the economy, whether local or at the state or federal level, without at least making some reference to unemployment. Things I want to point out here. For calendar year 22, annual averages, I tend not to get focused on the monthly shifts because there's some seasonality and some cyclical natures that happens. So I tend to look at the annual averages. And so for calendar year 22, Rock's rates about 3.8. The state's at 3.2 and the Fed's at about 3.7. And then if you look over a 5-year window, we're running about 4.4%. Certainly the remark was spot on that was made earlier that the labor shortage was certainly here and prior to the arrival of the pandemic. And certainly the numbers continue to bear that out. And I'm going to circle back on this slide when we get to my forecasts, which is my last slide here at the end of the presentation. So just hang tight in case somebody's got a couple questions already popping on that front. GDP. So again, this is the total value of all the goods and services produced countywide. And what you'll see here is a nice stair-step steady growth. Matter of fact, 8.53 billion was the number for calendar year 21. There's a year lag time. These numbers just came out for the MSA levels, and that was about an 8% bump from the previous calendar year of 2020. And then if you look over a 5-year window again from 17 to 21, about a 25% increase overall in terms of where that total GDP number has been. Sales and use tax collections, this is probably our strongest and most identifiable and tangible barometer of local purchasing power, and really a good indicator of what's happening in the overall economy. Again, this slide goes back to 2007. That was the first calendar year where the sales and use tax was actually implemented, and the first month that actually started to collect was in April. So that was in April through December reference for calendar year '07. Each and every year thereafter, it's been 12 months. What we have year to date for 22 is we're just over 17.2 million. And I fully anticipate, unless something really, really weird happens in the next 10 days, we should easily record north of 1.5 million. And in doing that, that should either equal or exceed last year's total of 18.11 million. So again, really steady stair step up and down in terms of what's been going on. This is a pretty good indicator of what's happening. Folks are feeling locally with their disposable income, and certainly also is reflective of bringing additional resources into our marketplace because of goods and services that we have here versus which may not be offered elsewhere, or perhaps it's, comes down to supply chain, geographic proximity, fill in the blank, convenience. All those bode well for the local economy. Next slide, certainly tourism expenditures for those folks that represent the CVB. This is their lifeblood, right? What you'll see, obviously, what happened during the pandemic in calendar year 20, really large dip, but a nice resurgence back up. Put that in context from calendar year, 2020 to 21. Again, there's a year lag time on these. It was a 25% increase. And so we fully anticipate, again, unless something really odd happens, we should exceed the 236.9 million that was collected and recorded for 21 to be at least that much higher for calendar year 22. And quite honestly, if you look what was happening prior to the pandemic, you can see some gradual increases as that continued to move up. Again, I fully anticipate we'll get back to that level. It may take another year to exceed 263.6, which was the collection total in 2019, but slow and steady will win the race on that one, that's for sure. In terms of equalized property values, again, this is all the combined values of all the different segments: residential, commercial, industrial, agricultural, so on and so forth. Really strong growth. You can see a nice upswing that has continued to grow each and every calendar year since 2014. The totals for 2022 were 16.9 billion. That was about a 16% increase from the previous calendar year. And if you look from 2018 through 22, you're pushing north of 46% increase. And if you start to kind of look at comparisons between other counties throughout the state of Wisconsin, you're going to find that Rock in particular, is in the upper third in terms of those gains and percentage differences from one calendar year to another. Certainly the residential component is a strong segment over the overall equalized property values on any given calendar year. Ranges from 70 to 71.5% plus or minus. What we see here is some really good growth, but obviously some ups and downs, right? Certainly coming out of the recession, lack of inventory, the inventory continues to build up. A little bit of hiccup with supply chain and whatnot. The good news is I fully anticipate that even though year to date we're at about 287 for calendar year 22, based on the projections, we should probably exceed about 360. So that would put the bar chart up to this level, and that would continue to keep our 5-year average running about 320 plus per year. And from 18 to 22, it's been about a 27% increase. So again, barring something strange happening in terms of a colossal cold that gives us, some pause on the residential side, we should continue to see some growth in that side of the equation. Price points are going to continue to climb as well. Certainly this calendar year, again, it's not a full calendar year, but median sale price for the typical residential home in Rock County, $234,000. And if you look over where that's been over a 5-year window, it's been about a 48% increase from 2018 to where we're at now, just on median sale price. In comparison to where we were last year, from 21 to 22, about a 17% increase. So in terms of what's been happening and how that trickles down into kind of the pipeline, for those of you that subscribe and read the Rock Ready Index, each and every quarter, we talk about the development pipeline. This is the combined and aggregate value of all the development and investment opportunities that are kind of coming our way in some shape or form through a variety of channels. This is a quick chart that runs down from calendar year 2010 all the way to the current calendar year. You can see on average during that stretch, we have about 44 projects that come through. Combined square footage is about 6.4 million square feet, about 4,100 jobs and change. And then CapEx is, pushing close to $1 billion, depending on what calendar year it is. To put that in context, where we're at for calendar year 22, again, the year's not over, but given how things happen with the holidays approaching, and I've had 24 plus years of seasons to gauge this, I don't anticipate we'll have much more activity before the end of the calendar year. The good news is this: although the number of projects for calendar year is down in terms of numbers, again, we're at about 26 coming through the pipeline. Really strong square footage. So numbers down, but the footprints are up, job counts are up, and the CapExes are also up on that front. You can see the comparison between calendar year 22, where we're at year to date, and then what that stretch was from 2010 all the way through 22 as well. The pie chart over there gives a breakdown based on where these industry segments have fallen in, at least in terms of 22. Apologize for the small print. Green is food, orange is metal fab, yellows is plastic. The black pie shape, 23% is other types of manufacturing, logistics, 19%, and then other sectors that don't fit in nice and neat into any of those other buckets fall into there. And again, depending on the calendar year, depending on what's going on at the federal level with policies and whatnot, you can see some shifts incrementally, but each and every quarter, each and every calendar year, our mainstays are food, logistics, metal fab, and plastics. That doesn't change a whole heck of a lot during the course of the calendar year, assuming there isn't major shifts at the national level. So kind of talk about the forecast, what it means. So certainly Michael's presentation had some real good data on where things are headed, both in terms of domestic and foreign side of the equation. And certainly those policy priorities will continue to impact things locally, specifically whether it's a full-fledged technically defined recession or one that both the media and the political folks agree on. Either way, inflationary pressures as well as recessionary pressures are there. A couple caveats here that are local. The Belvedere Stellantis Jeep plant, for all intents and purposes, if you haven't caught the news in the last 7 days, that plant has been idled. For those of you that are from this area, you know what that means. Okay, you can fill in the blank, but spoiler alert, there's a highly strong likelihood that once that plant is idled, it may not open up again. We've already been through that rodeo here locally from 2008 to 2010. We know what that hole looks like. We certainly know the challenges that it presents itself. What we don't know right now is what does it mean regionally in terms of supply chain. We also don't know what it means in terms of headcount, in terms of the number of employees that will be impacted down there. I can tell you this, given the number of buildings that have been built in the extended region to support that supply network offsite, there's probably going to be a fair amount of real estate priced extremely favorable to get that refilled and backfilled by non-automotive uses. So that will certainly put some pressure on the development activity north of the Cheddar Curtain, as our friends south of the border like to refer to us as, and we'll have to continue to see how that plays out. Certainly, supply chain considerations and continued economic diversification will, I think, play in our favor. And when we talk about economic diversification, two main examples that are easily identifiable, think of Shine Medical as well as North Star Down and Beloit. That's just two primary examples that don't necessarily fall within our traditional industry sectors that we talk about, but certainly as those companies continue to ramp up their local production and as they continue to fulfill and build out their supply chains, it's reasonable to assume that there's going to be continued economic growth associated with that. And more importantly, as the need to fulfill that last mile of fulfillment for product delivery and to take into account what's will likely happen with fuel prices, perhaps jumping at some point in the next 4 to 6 months, certainly being situated where we are at geographically really creates a competitive advantage for us right here in the Janesville Beloit MSA. Certainly, if you want to talk about disposable income, if you want to talk about sales tax collections and other types of economic development activities, can't have the conversation about without making reference to the Ho Chunk Casino and Resort that's been proposed down in the city of Beloit. Certainly that has received its federal approvals and they are in their due diligence phases right now in terms of both financial as well as construction related activities. So stay tuned on that. And then certainly as recent as this week's council meeting, the Woodman Sports and Convention Center here locally within Janesville continue to gain steam. No doubt the residential activities, in my opinion, will continue to move forward irrespective of what the fallout's going to be with the Belvedere Jeep plant. There continues to be demand from both north and south, as well as east and west, in terms of, two wage earner households, one working locally, the other commuting out of the area for work. And so our price points, as well as amenities that continue to grow, I think really positions us extremely strongly. And last but not least, at the end of the day, workforce and talent, real estate and capital are going to continue to drive things. And so those are the areas in particular that our team and our extended members of our team are going to continue to stay focused on as we move forward into calendar year 23 and beyond.
Well, James, thank you so much for that. And while I've got you here, I've got a couple questions that have come in here in the last couple of minutes. One specifically for you. Can you talk about your opinions about what you think the driving force was behind the plant idling, the Jeep plant idling? Give us some color there.
Yeah, so mind you, not an expert in that product line, even though I do own a Jeep, and I've been a fine Jeep owner for a number of years. This is my second one in the last 20 plus years. But here's what's happening. They have an operation down in Mexico, and they also had ceased their joint venture with China. And they also have invested heavily into the Detroit, Michigan kind of EV product side of the equation. So as the corporate office at Stellantis has continued to double down on electric vehicles and where they've pushed those investments, they're going to continue to drive production into those plants. Given the fact that the Belvedere plant was built roughly 1954, and given the fact that although they've had continued, certainly model changeovers and investments in that plant, one could make the argument that there's some functional obsolescence associated with that plant. And perhaps that capital investment to bring that up to speed with the other proposed plants that are building or will be building similar models is just too tall of a hill for the company to swallow or to climb at this point. So that's just my observation. And if you look what's happening with the overall automotive industry over the last 10 to 12 years in particular, there's this gravitational pull down towards the south. And if it's not pulling down towards the south, it's concentrated in the extended Detroit, Michigan metro area.
Well, thank you, James. Good to know, and certainly worth keeping our eyes on. One other question, this is for both of you. Wanted to know a little bit about your thoughts about the amount of stimulus money that's still in the economy and what effect that could have on delaying the return to normal levels of inflation. Michael, you want to start with that one?
Well, sure. I mean, like the past stimulus that we've seen in terms of direct stimulus to households, we're still living with that in terms of elevated levels of excess savings. And to the extent that gets unwound or used or pulled down, that will provide more towards spending and add to inflationary pressures that ordinarily wouldn't be there. But there's a couple other areas, bills that have been passed very recently, the infrastructure program and the Inflation Reduction Act, which may not be the best name for that, but at least both of those bills had the infrastructure, obviously a lot of money towards infrastructure spending, net new money to the tune of about $550 billion. It was a $1.2 trillion bill, but a lot of that was just regurgitated money that had to be used anyway. So you look at $550 billion, the Inflation Reduction Act had another $300 billion of funding for infrastructure, particularly with respect to the climate change file. So that's an awful lot of infrastructure. And so number one, that's more spending in the economy. It's the kind of spending I like to see because it's capital spending. It's increasing the capital stock, which allows the economy to grow even faster down the road without having inflation pressure. So you don't mind having, that little extra spending pressure now because you're going to get the benefit down the road. That said, these are, spending that will be competing for a lot of the construction goods and construction workers that are still in short supply out there. So it will be somewhat inflationary as well. Now, meanwhile, the higher interest rates themselves have taken a lot of steam out of the economy. But there's no question there still is a lot of stimulus here. And when you think about, whether or not we get an official recession or not, or how, the economy is going to be weakening, but from a grand scheme of things, if you think about your typical recession has a 3% contraction in the economy, we are going to see that mainly because we still have that support for the economy.
James, any thoughts about that particular topic?
Not really. I mean, that was well said, and I don't have a whole heck of a lot to add other than the following nugget. So if you try to dive into and look at kind of the expansion and contraction side of the equation, and one of the indices that I tend to follow more frequently than other is the PMI, right? Purchasing Managers Institute. That's kind of the sentiment, right, in the manufacturing. So when you've got levels at 50% or higher, generally that means there's an expansion on the horizon or expansion ongoing, versus when it's below 50%, that usually signals contraction. So just to put a little color to that, right? So August 2016 was one of at least the most recent periods where we dipped below 50%. That was 49.4%. And then if you fast forward to 2019, basically August through December, both of those months rather, were clocking right below 50%. November of 22, again, below 50%. So that's one to keep an eye on, and that's usually a pretty good barometer of what's going to happen in terms of expansion or contraction. The other thing I might add is that in terms of local spending numbers, at least in sales tax kind of nomenclature and quantification, were up prior to the stimulus dollars showing up, at least, in residential pockets. So I think, probably 1 or 2 years from now, we can really look back and make a determination on how much of a bump, if any, that additional stimulus dollars really went to the sales tax collections on an annualized basis. We just don't have enough longitudinal data to say definitively right now whether it was a major cause for the bump to go up or not.
Good deal. Well, we have reached the end of our time here, so I just wanted to thank both of our experts here, Michael Gregory and James Otterstein. This is really great local and national data, and we appreciate it so much. I want to once again thank BMO Harris Bank for their support of this webinar series. It's been excellent. And to thank Michael for his time. James, thank you as well. We're lucky to have you in this area. I know I tell you that often, but I can't say it often enough that we're very lucky to have an expert of your caliber in this area. So thank you for all the work you do. We have recorded this webinar. We will make the recording available far and wide. So look for that on our social media channels and other places and some of our publications. And wish everybody a very happy holiday and a happy new year. And we look forward to reconnecting with you in 2023. So thanks again, Michael. Thanks again, James.
Thank you.
Thanks, everybody. Thank you.
Have a great day, everybody. Thank you.